Okay, so today I want to start accounting chapters. This is chapter 3. And probably everything you see here, you will see here, you already covered in the accounting class before. But I think it's going to be a good reminder for you. If you're one of those people who forgets about the class once the semester is over, then it will be a good thing for you to have. In this first chapter of accounting, we will talk about financial statements, balance sheet, income statement, and statement of cash flows. In this, probably on Tuesday, we're going to finish this chapter and start the next chapter. And in chapter 4, we will talk about financial ratios and what they mean. Okay, first of all, why are we dealing with this? Because accounting is important for finance people to understand how well the company is doing. So we need to know where the numbers are coming from. Yeah, we are using those numbers, but we need to know where they come from. Otherwise, people would trick you. And the key financial statements we talk about is the balance sheet, income statement, and statement of cash flows. I'm going to start with balance sheets. You probably remember what balance sheet is. It's basically a financial statement which tells you what the assets and liabilities are for a company at a particular time. So it's basically the snapshot of how the company is doing at that time. And it's a cumulative statement. So when you have the financials, when you have the balance sheet for 2014, end of 2014, when you look at that statement, you know about the entire past, entire history of the company. It's a snapshot of the company, basically. And you all remember this equation, hopefully. On the left-hand side, you have the assets. And on the left-hand side, you have debt and equity, or liabilities and equity. And the balance sheet should be in balance. Okay, when you look at the balance sheet, here on the left-hand side, we have the current assets. These are the most liquid ones. What is liquid?
Easily to be turned to the cash.
Exactly, easily converted into cash. And of course, cash is the most liquid thing. Cash and marketable securities. Then we have accounts receivable. What is accounts receivable?
The money which will be taken
From customers. Okay, exactly. You sold stuff to your customers, but you didn't get the money yet. So it's account receivable. So it's almost you make the sale on credit.
But it's not only when we sell something, right? It's also when people owe us money.
Oh, it is accounts payable. What do you mean? They owe us money. What kind of money? Like, why do they owe us?
Maybe,
Where does it come from?
maybe because we give debt to people.
Oh, okay. Yeah. Now I understand what you exactly. So whenever you gave something to someone and you expect them to return it to you, then you can put it in account receivable, as far as I know. But I have to check about this. Okay. So basically, everything on the left-hand side is what you own. Everything you own is on the left-hand side. And we have inventories. These are also important. All the supplies you use for production. Unsold product is in the inventory as well. Then you have longer-term investments. Like you have plant, property, and equipment, factories and machineries and everything. If you deduct accumulated depreciation from this, from plant, property, and equipment, it will give you net fixed assets. And if you remember, net fixed assets are the ones that create value to the company. These are important. And these are all tangible. You might also have intangible assets that you all know. What are the intangible assets? Patents, copyrights, trademarks, brand names, everything. So from the most liquid to the most illiquid, you write them down. On the right-hand side, you have what you owe to other agents. Stuff you don't own, basically. You have to return them back to owners. You have accounts payable. What is accounts payable? Huh? Like what? What kind of debt?
Like you borrow money from a bank.
Oh, this is account. It's not notes payable. It's accounts payable. You bought something from a supplier. You bought a service, whatever, from someone, and you didn't pay it back. It is kind of the opposite of accounts receivable. This time you bought something on credit. You owe money to this other person. Then you have short-term debts. Short-term means less than 1 year. Then you have long-term debt, debt more than 1 year. It can be bank loan, bonds, whatever. It's something you owe, basically, something you have to return to the owners. Then we have shareholders' equity, preferred stock or common stock. I remember one time we gave balance sheet entries to the students, and we asked them to form a balance sheet. And with the entries, the balance sheet was not balanced, and it was the purpose of the study anyway. And we had everything, so we were expect students to write, okay, this balance sheet is not balanced, so this part or unbalanced part might come from, I don't know, shareholders' equity, for instance. So you have to make it balanced. Okay. And normally, I don't know what our policy will be, but we don't ask students to memorize anything. We either give formula sheets, or we let you prepare formula sheets for yourself. But if we give formula sheets to you, the balance sheet, income statement, statement of cash flow items will not be on the formula, because it's not a formula. So you have an idea how to construct balance sheet and income statement. But I will let you about our policy once we decide about it. Okay. Okay, we talk about all of these, so I will move. Let's go into this very simple example. It says, which of the following assets is typically considered most liquid? Which one is least liquid? So, marketable securities, accounts receivable, and inventories. Which one is the most liquid one? Let's. Which one is most? Marketable securities is the most liquid one, then account receivable, then inventory. Okay, very good. Which of the following is a current asset? Property that a firm owns, a firm's production equipment, unsold inventories. Is it unsold inventories? Yeah. What is, okay, property that a firm owns, is it an asset? Yes. Firm's production equipment, it's an asset. But these are in the plant, property, and equipment part, so these are long-term assets. But I'm asking about current assets, which should be shorter term, or most liquid, let's say. Unsold inventories is a current asset. So this part is current assets. Cash, marketable securities, account receivable, inventories. Perfect. Then we have the liabilities. I think we talk about liabilities as well. Let me go into this. Which of the following is a current liability? Current liability. A bond debt that matures in 3 years. Bank loan that is due in 24 months. An obligation to pay a supplier within 6 months.
An obligation.
It should be C. It's not A or B because A or B are long-term debt. Since I'm asking about current liability, it should be short-term. And this C is what? Which entry? Accounts payable. Perfect. You bought something from your supplier. You're going to pay it back within 6 months. Perfect. Okay. What is net working capital? This is something we're going to use a lot, so you need to know the definition. Net working capital is basically the difference between current assets and current liabilities. So in the current assets, what do we have? Let's write it down. We have cash, marketable securities. We have accounts receivable. We have inventories. In the current liabilities, we have accounts payable or notes payable, for instance. So the difference between these two will be net working capital. Why is net working capital important? Because it tells you the difference between the most liquid assets you have and the most liquid debt you have. So anytime you need to be able to cover your short-term liabilities with your short-term assets. So it's basically the money, the difference between these two will give you an idea about how much this company has for the daily operations. Whether I'm able to cover my short-term liabilities with my short-term assets is the net working capital. I don't know whether you can see this. Probably not. Okay, let me read it. So this is the balance sheet for Home Depot. It's from your book for 2008 and 2009. So this is like a real balance sheet. And also when you do the company information homework, you can find the financial statements of companies on any finance page as well. You don't have to go into the company's website. So if you have time, just click on it. Actually, the next homework will be to find the financial ratios for those companies, so you're going to do those anyway. But be familiar with the balance sheets and other financial statements. One thing, this is not an accounting class, so the difficulty level or the complexity level we ask for is basically limited to this. That's it. I mean, this is not going to be an accounting class, so you should just have basic accounting information so that you can do finance. That's what we're asking for. So here I have cash and marketable securities, account receivable, inventories, other current assets. Then we have fixed assets, tangible fixed assets, plant property equipment, minus accumulated depreciation. So it gives you the net tangible assets, net tangible fixed assets. You have the intangible assets. Goodwill is also here. Goodwill is also written when you do a merger and you pay more than the value of the company. The difference goes as goodwill. Of course, you have to pay more than the value of the company you're buying because it should be a profitable thing for the other company as well. So it goes under intangible assets as well. This is the synergy you're going to create. It's an assets you own because of this merger as well. And then you have long-term investments, whatever they can be. So left-hand side gives you the total assets. The right-hand side, left, right, yes, right-hand side, we have debt due for repayment, short-term debt, accounts payable. Then you have long-term debts, deferred income taxes, income tax you were supposed to pay but you didn't yet. So you owe it to the government. It's also here. Then you have shareholders' equity. Book value of equity is on the balance sheet. We have common stock, retained earnings, treasury stock. And of course, this is balanced. One thing I'm going to ask is treasury stock. What is treasury stock? And why is it is negative? Common stock is positive. You sold stock to your shareholders. It's positive. But treasury stock is negative. So negative means you paid for it. What is treasury stock?
Dividends?
Dividends are not on the balance sheet. Treasury stock.
It is like the shares that the company bought from the markets.
Yes. What's your name?
Bitter.
Bitu is my favorite person now. Exactly. Yes. So treasury stock. There were shares outstanding. It was issued, sold to the public, but then the company bought back some of them. And why? And they became treasury stock. They were issued stocks. They were bought back. Now it's in the treasury. It's staying in the treasury. The company can resell them with a financial market operation. But now it's negative because the company paid for it. The question now, not directly related to the class, but why do you think companies buy back stocks? Oh, Betül again. Yes. Huh?
To increase the value of the stocks later.
Why? How can they do that?
To show the stocks valuable.
Okay. What's your name? İpek. Okay. İpek has to be my second favorite person now. Very good. What else do we have? Let's just keep on brainstorming. Why do companies buy back their stock? It's
Sell it at a high price.
ooh, fishy. Actually, okay, so one way to return money to your stockholders is to pay dividends, right? For the stock you have, I pay you dividends. The second way of the payout policy, if you remember this payout policy, is to buy back shares from you. So instead of paying you dividends, I want to return money to you. And I say, okay, I'm going to buy back the shares. The company might be doing it for only to give money to shareholders, not as dividends, but as buying back the shares and paying to you. Or maybe they are gonna, they want to restructure the ownership structure. That might be another thing. Or maybe they want to reduce the numbers of shares outstanding. But generally, if a company is buying back their shares, do you think they believe that the stock is overvalued or undervalued? The stock's value as of now is higher than what it's supposed to be or lower than what's supposed to be? Let's think about it. We will talk about it next Tuesday. Okay. Just think about why companies are buying back stocks. And would a company buy stocks if it is overvalued or undervalued? Or what shareholders think when a company says we are buying back our shares?
I think they'll expect that it will increase the shareholders.
Uh-huh.
If the company buys back its own stocks, apparently they got an expectation for them to be rising.
Mm-hmm. Mm-hmm.
So it's a good sign, good indicator for stocks to increase.
It feels like it's a good thing, right? What do you think?
If a company makes some long-term investments, they are expecting returns of that.
Uh-huh.
They believe that the long-term investments return that they will get lower. But if they have a lot of shareholders, they need to pay down some parts.
Uh-huh.
Probably they can buy back their shares to not pay them.
Uh-huh. So you're saying they want to reduce numbers of shares outstanding, basically. That might be something. And you say it's probably undervalued when they buy back the stocks, because if it was overvalued, the company would be stupid to buy. They wouldn't buy something at a very high price. So actually, yes. So when a company is buying back its shares, the signal is the company value should be higher than it is now. So they're buying the stock at a low price in the expectation that it's going to increase in the future. And just because of that, shareholders might be happy with this. Sure, yeah.
Şimdi para ihtiyacı oldukları için hisselerini sattıklarına göre önce
Şirketler, evet.
şirketler artık geri aldıklarına göre böyle bir keşe ihtiyaçları yok ve istedikleri level'a ulaşmış demeklerdir
Haha.
diye düşünüyorum ben.
That's also right. That's exactly right. So basically, she said, okay, the company issued stocks at some point in the history, but because they needed money. But now they are buying back the stocks. It means the company has enough cash now to buy back stocks. She's exactly right. It's payout policy. If a company doesn't have money, then they cannot pay dividends and they cannot buy back their shares because they need cash for both of the cases. She's exactly right. Name? Nilsu. We will see. If I can memorize like 10 names out of 53, it's going to be a success for me. Yes. Efe. Okay. I remember my Twitter friends more, followers' name easier. Okay. Yes.
But as you can see, there is business life, a lot of companies, which is really big companies, that can be doing also. They are still open. Their shares still open in the market,
Uh-huh.
like Microsoft, Apple, Google.
Mhm.
I believe that they don't need money. They have enough money. Why they are keeping their shares open?
Oh, I mean, why don't they become private again? They make tons of money with all those. Okay, money is never enough. Let me give you a life lesson, okay? I know lots of rich people. They never say, "Oh, I'm enough rich. I don't need more money." But like jokes apart, there are lots of advantages of being in the public, especially if you're a good company. If you're bad, you don't want to be in the public eyes because there are lots of analysts following you. There are lots of bloggers, investors. Everybody is following you every little action. So there's lots of monitoring. So unless you're doing something shady, it's nice to be in public because it's investment and it's also product sale going hand in hand. Okay, so if you have lots of investors, company, the first thing everyone does is they look at how the stock market is doing. If the stock market is well, we're all better off, right? So when a company is in the stock market and if it seems like it's doing well, it's going to be reflected on other things. So everything is egg and chicken relationship, right? You have to do well to be well in the investment side as well. If you're doing really good in the investment side, it's going to reflect on your customer relationships, debt holder relationship, stockholder relationship, everything. So it's nice to be in public. Yes.
Maybe.
And also, they make ridiculously amount of investment. So maybe they don't want to use their own money. They want to have additional debts. And when you're a public company, since there's lots of monitoring, cost of debt is getting lower for you.
I want to ask another thing.
If it is it related to what we were talking about? Let me just take this. Yes.
For example, if I were Apple CEO, I would like to buy the stocks before introduce the iPhone 6 because I know its value will be increase after introducing new product. And when the stock prices are low, I would like to buy it before the introduction.
Okay, if a manager in the company buys or sells his stock, what is called? Do you know what it is called? If someone in the management is buying, selling his stock, it's called insider trading. And it has to be really transparent. If you're doing it in a shady way, if SEC figures that out, you're going to be troubled. according to the rule, you cannot buy and sell based on your insider information because it's privileged information. It's unfair to the rest of the agents. But now, in US, it's becoming really transparent. And in some magazines, like maybe Economist has it, you see the insider trading actions of all the CEOs all the time. So it's becoming more transparent. If they announce it, that they're going to buy this, it's fine. But if they try to do it secretly, it's a big trouble. Also, it's about expectations. Like we know when it was going to be launched, right? Did we know the announcement date of Apple 6? I mean, probably everybody was expecting. Nobody was expecting a revolutionary product.
We learned before a month, like the introduction.
But before that, the stock price started to increase before the announcement because of the expectations. Because you thought that there was going to be an announcement, it's going to be good. So people started buying the product, Apple stock. So you saw the increasing trend in the stock price. Then at the announcement, it increased more for some reason. I think everything was like well expected anyway. What was I going to say? So CEOs or managers cannot do it in secret. Efe, what was your other question?
When the shareholders buying your shares, is it coming back to like cash or is it coming back to?
Like I issued stocks and sold it to public.
Buy the shares.
I'm Apple. Who am I? Who am I?
You're a shareholder.
Oh, I'm a shareholder. Okay. You're Apple.
Yes.
Okay.
When you buy stock from Apple, is it coming back to you like a
Yes.
cash?
If it is a new issued security, yes, you're getting the money from me. Ali Baba, ismi de süper. They raised how much million? 20 million? To 20 something, $25 billion. So what happened was the stock was issued, public like investors bought those stocks, and all this money went to the company, $25 billion. But if two people, like now Alibaba is done with the IPO, there were 100 shares, let's say, they sold all the 100 shares. After that, the transaction occurs between you, and the money doesn't come to me. If the transaction happens in the primary market, it's a new issued security, then the institution gets all the money. Okay, now let's continue. So we saw the normal balance sheet, then we have the common size balance sheet. In the common size balance sheet, everything is in percentage of total sales. So you're going to see actually the same stuff, but now the assets will be 100%. Think about a pie. And the balance sheet, everything in the balance sheet tells you the slice of the pie in percentages. Like here, for instance, 3.5% of the assets is in the cash form. Or 25% of inventory, 25% of assets are in the inventory form. Why is this useful? Name?
Yağmur.
Yağmur. Okay.
You know the liquidity of the company and you know where the money goes.
Mm-hmm. But you know those in the balance sheet as well. Why is common size balance sheet useful? Why having the percentages instead of numbers is better?
To calculate ratio.
Name?
I can.
Okay. Okay. Now here everything is in ratios, which is way better than having actual numbers. And it's because
you can check, for example, you can compare companies to others without any, for example, the company with more high value, and the other will low, but you can compare what they have in a percent maybe.
Very good. And your name is?
Oğulcan.
Oğulcan. And it's a managerial accounting book. Why do you have managerial accounting? Oh, okay. Okay. No, I thought it was like financial accounting. You already took financial accounting, right? Which was a prerequisite. Sorry, my bad. Oğulcan. Oğulcan's explanation was like answer key explanation. Exactly. So with having the ratios or percentages, you can compare apples and oranges. So you can compare different companies. One might be a very small company, one might be a very big company. So for big companies, the numbers will be really big, right? So when you compare inventories or cash, whatever, of course, in every form, the big company will look way better. Because in actual numbers, it's a bigger company. But with percentages, you know, no matter how big your pie is, you know how the pie is sliced. So it enables you to compare different companies more comfortably. Even if you're thinking about your own company, it's nice to have this because suppose that your company had a big merger the previous year. So the balance sheet items like skyrocketed because now you're a way bigger company. So you might look very good even if you're not that good, or you might look very bad even if you're not that bad. So the numbers will go very up or down depending on the entry. So by doing this, you know, yeah, slice got bigger or smaller, whatever. But now you know the percentages, how the slices were cut, and you can make the comparison easily. So this is the usefulness of common size balance sheet. Okay, now let me remind you the difference between book value and market value. Okay. So we already covered this like 100 times. So basically in the book value, we know the values of assets and liabilities according to the books, according to the balance sheet. Everything we have there is the historical value. But the market value is, the question will be, if I sell this, or if I have new debts, let's say, what the market price, market value will be for whatever you have in your mind. What I'm trying to say is this. Let me just go. Okay. This is from Ford's balance sheets. We have assets and liabilities. Okay. So here, for instance, total equity is minus $642 million. So as of December 31st, 2010, the value, the equity value, book value of Ford was negative. But then I said, okay, this is the book value. I'm very interested in market value. How am I going to find the market value? I need the price and numbers of shares outstanding, which is the market capitalization. I need to find this from a finance page. So I looked at Ford's market capitalization at the end of December 2010. It's $25 billion. So as you can see, book value is different than the market value. The same thing happens for the debt part. This is kind of more difficult actually. And probably you don't see anything, but basically this says the debt part. Here you have the total debt, 19,077 for instance. This is the book value, how much debt you got, what was the interest rate. The market value of debt is harder to find, but basically you should say, if today I would have the same debt with the new conditions of the economy, well, what would be the fair value of debt? Sometimes companies put it in their balance, in their footnotes as well, the fair value of debt. Here, the fair value is given, it's 19,260. It's slightly different than the book value. So book values are different than market values. Let's look at this question. It's very simple. According to GAAP, your firm has equity worth $6 billion debt worth 4 billion, assets worth 10 billion. What is GAAP?
It's a way of doing accounting.
Yes, it's a way of doing accounting, and there are two big systems in the world. One is GAAP, the other one is IFRS. Which one is used in Turkey? IFRS. And I think only Japan and US is using GAAP. Okay, since this was from your book, and it's a US book, it says GAAP. But according to the accounting rules, your firm has equity worth 6 billion, debt worth 4 billion, assets worth 10 billion. The market values your firm's, oh, there's a typo there. Oh, no, it's fine. Your firm's 100 million shares at 75 per share and the debt at 4 billion. So what is the market value of debt? What is the market value of debt? The market values your debts as, so this is the market value. What is the market value of equity? Huh? 7.5 billion. You have 100 million shares at $75 each. Multiply these two numbers. So the market value of equity will be 7.5 billion. Book value of equity was 6 billion. It says according to GAAP. It's accounting standards, so it's a balance sheet item. And the book value of that was $4 billion. So the book value and market value is different in most cases. Okay. So the book value of your assets is 10 billion from the balance sheet. The market value of assets is different because the equity, market value of equity is 7.5 billion this time. So the total asset value is 11.5 billion. And we said market values are important because market values are forward-looking. Book values are backward-looking. Okay. Okay. I will stop here at the, not here, at the 22nd slide. So I have 3 more slides. Then we will go. Okay. Income statement. Where is the attendance sheet? Attendance sheet. Could you? Okay. Income statement is different than the balance sheet. Balance sheet was the snapshot of the company at a time. But what was it? Income statement is a flow statement. So it basically tells you what happened in that particular period only. It's not a snapshot. It only tells you what happened in that particular period. And it tells you the revenues, expenses, depreciation, everything related to income, basically. This is the very basic structure of income statement. You start with sales or revenues. How many items you sold, at what price. You have costs, administrative costs, selling, general, and administrative expenses is one thing. Any kind of cost goes there. You have depreciation. What is depreciation?
The value, year by year, the value of the product.
You bought a machine, and the value of the machine goes down every year because of yıpranma. Because of huh? Yıpranma? Because you're using it. Yeah, yıpranma. It's becoming obsolete. I remember we used to use obsolete. Yes, so its value decreases every year. So you find EBIT, earnings before interest and taxes. Then you pay interest to your debt holders. Debt holders get money first. Then this is taxable income, earnings before taxes. From that taxable income, you pay tax to the government. Then you end up with net income. Net income can be distributed to shareholders in the form of dividends. If not, if it's kept in the company or whatever is not paid to the shareholders is addition to retained earnings. And that's the money kept in the company for future investment or whatever the company wants. So here we have a normal income statement and we have a common size income statement. Normal income statement starts with net sales, cost of goods sold, selling, general and administrative expenses, depreciation. Then you have EBIT, minus interest if you have debt, which will give you taxable income. Then you pay tax on taxable income. In the exam, sometimes you calculate tax using sales. I don't know why. Please don't. So this is easier, right? You calculate tax according the item just before tax. That's easier. Don't go to sales. So you find EBT, earnings before tax, which is taxable income. You pay tax to the government. You find the net income. Then you might pay dividends. Here, in that case, 2.6 is the net income. 1.5 of it is paid as dividends. The rest is addition to retained earnings. You can write the income statement as in the percentage of sales. This time sales is 100%. From the sales, what each entry has is written in the common size income statement. I will ask you two things. I will show you one thing and then ask you one thing. Okay, one is, what is the tax rate? You have the income statement. What is the tax rate? How do you calculate the tax rate? So from taxable income, you have some tax rate, which will give you the taxes paid, right? So from here, taxes paid is 1362. Taxable income is 14023. From here, you can find the tax rate, which should be around 36% or so. So if you already know the tax rate, then you multiply tax rate with the taxable income and you find taxes paid. Last thing, addition to retained earnings, 1136. Keep this number in mind, 1136. And this is for 2009. One more thing. When you look at this, this tells you in 2009, in that year, you had a sales of $66 million, only in that year. Not cumulative sales, only in that year. Last thing, addition to retained earnings should be in the balance sheet. Probably you don't see it. Oh, this is common size, okay. Okay, here, if you compare the retained earnings from 2008 to 2009, the difference will be 1132. 1136. So all those things are related. Addition to retained earnings is written in the balance sheet. So in 2009, you have additional 1136 retained earnings, which is added to your 2008 number. Okay, have a wonderful weekend. I will see you next Tuesday.